All right, happy Monday, everyone. Welcome back. Chris here, as always. Going to give it a second, like I'd like to do, to give everyone a chance to log in and get connected here. I know it takes a minute sometimes pulling everyone over from the Click Meeting waiting room, so gonna give it a second here, then we're gonna get started. One, two, three, four, close enough for me. Let's go, guys. So today we are going to dive into the differences of sideways versus trending markets. We're going to get started, as always, with a little bit of introduction about myself. We're going to go over some disclaimers, and then we're going to get on to the juicy stuff that everyone's here for. So let's rock and roll. Hopefully everybody's having a wonderful Monday. My name is Chris. If you haven't met me, I am a trader and mentor here at Earn to Trade. I run all of these webinars as well as do the daily recaps and educational lessons. I also do mentoring as well. I do enjoy teaching as much as I possibly can. I feel that I gain more from seeing other people grow than I do from making gains just by myself. So let's get rocking and rolling. Today we are going to be covering sideways versus trending markets. Like I said, the goal of this webinar is rather simple. We're just going to continue expanding our knowledge on trading and learn about the differences of sideways versus trending markets, how they might potentially be traded, and how to properly identify the various types of sideways versus trending markets. How we can say, okay, this is what we're dealing with today, so I know how to respond today. But without getting any further down that road, let's go ahead and cover our disclaimers. I'm going to read the first disclaimer. I'll leave it on screen for a moment while I'm reading it. Then after that, I'm going to cycle through the next ones thereafter. Please screenshot them or read them yourself. I'm not going to through the ones that are after. I'll let you guys do that. I have faith. So here we go. So, beginning our disclaimer journey together. We'll make it through, folks, I promise. Earn to Trade is provided to you for educational purposes only. Earn to Trade is not a financial services company. Earn to Trade does not accept any liability for loss or damage as a result of reliance on the information contained herein. This includes educational material, price quotes, and charts and analysis. Please be aware of the risks associated with trading the financial markets. Never invest more money than you can risk losing. The risks involved in trading are high and may not be suitable for all investors. Earn to Trade doesn't retain responsibility for any trading losses you might face as a result of using the data shown on its websites or webinars. The data and quotes contained may not be provided by exchanges, but rather by markets. The prices may be different from exchange prices and may not be accurate to real-time trading prices. Any examples used are not a recommendation to buy or sell or a solicitation to buy or sell futures, options, bonds, or binaries or securities of any kind. The information and strategies and techniques discussed herein are the property of Earn to Trade LLC. They may not be shared or distributed to another party without the express written consent of Earn to Trade LLC. Any trademarks, copyrights, reference other than Earn to Trade are the property of the respective holders and not Earn to Trade LLC. Okay, and on to the next one. Once again, just take a moment to briefly read on through it or screenshot and read it at a later date. Moving along, folks. Same scenario. Go ahead and read on through, or screenshot and read at a later date. Keeping her flowing. And just one more after this one, folks. And finally, our final disclaimer, and then we'll be on our way. Alrighty. So diving right on into things, just putting this on the screen for a brief moment. Once again, today, guys, we will be discussing the differences and how to identify a sideways versus trending market. Now, right off the bat, I would like to say that technically speaking, a sideways market and a trending market are both technically trending. Both market types are trending. So what I mean by that is a directionally trending market either upwards or downwards, or a market that is literally just moving mostly sideways. Those are the differences between what I'm talking about, so we're both on the same page before we go further. Obviously, one market type is more indicative of a market that seems to be trapped or exhibiting some type of low volume, working its way between a high and a low, essentially speaking, some area of resistance and or support, whereas a trending market is a market that has more bullish presence than bearish presence, or more bearish presence than bullish presence, but has a clear directional heading. It's either making progress mostly upwards or progress mostly downwards. Whereas, like I said, the sideways market is self-explained, rather mostly moving sideways. So getting ourselves started off here, guys, I'm going to go ahead and switch on over to my charts. Here we are. So we're currently looking at the euro dollar. We're currently looking at the Forex pair, the euro dollar. I might switch around today, might go on over to the ES. We'll see how I feel with the examples that I'm able to find here with the euro dollar. I have noticed a few things when I was looking at the charts already, but I didn't go back too far because I wanted to keep this fresh. As we work our way forward here, guys, please feel free to ask any and all questions. Type them on into the chat box. That is the main reason you are here, is to take advantage of me being here with you live so I can answer your questions in real time, and you can have a more adept understanding of what it is we're talking about, and hopefully learn a little bit more and be able to implement it a little bit quicker by taking advantage of being here with me live and not just simply watching it after the fact. If I don't answer your question right away, don't panic. I will get to it. You don't have to retype it. I will get to it. I might not be answering it because I'm waiting for a specific setup I'm looking for, or perhaps I'm just waiting for a little bit of a downtime in between what I'm speaking to go ahead and cover it. But please ask anything. Don't be afraid. And like I said, if I haven't answered your question right away, I will get to it. I will answer every and all questions. But there is a chance that, like I said, I don't answer because I know I'm about to answer your question to everyone as a whole as we move along. But other than that, so taking a look at the euro dollar here, we're going to start talking about what these things are that I'm talking about, these trends, these bullish trends, these bearish trends, and these sideways moving trends. Now, determining the trend of a market is arguably one of the most important things we have to do as price action traders. We want to determine whether the market is trending or not, because this heavily determines whether or not, one, we want to trade based on what type of trading strategy we're implementing. Obviously, it's going to be completely dependent on what it is you're choosing to use. But it is critical that we understand how to properly differentiate between a trending market and one that's moving sideways. If we get ourselves caught up in if we're unsure of which way the market's going, obviously that's a huge problem in and of itself. But if we're unsure if the market really is trending upwards and we're jumping in at an area of support we found during a sideways moving market looking to go long, I'd be very happy with the results. We might pull some profit, but if the market's just ping-ponging between two central tight locations, we don't really stand to gain a whole lot, and it really might not be worth our time. So being able to identify a trend is extremely crucial, and we're going to talk about, once again, how we can identify and differentiate between a market that's moving sideways versus one that has some type of directional heading, which is what more people refer to as a market that just simply has a trend. And you'll hear a lot of times in the trading world, people will say, the trend is your friend, and a lot of times, in most cases of trading, it really is, because the overall picture, the big mover, when we're trading the market, we're generally speaking making money based on how far the market moves in one direction. Obviously, there are types of trading where that's not necessarily the case, but for the most part, if we're simply trading Forex or something that gives us value based on a point system, the more something goes in our favor, generally the more we stand to gain, just like the more something goes against us, the more we stand to lose. So when the market is trending, being able to properly identify if it is strongly going upwards or it is strongly going downwards, and then keeping ourselves in that overall direction, we're kind of giving ourselves a security blanket, and we're kind of giving ourselves a much higher potential, much higher ceiling for the gains that we're looking to make. So if you've been struggling with just being able to identify trading, or just being able to identify what type of market you're actually looking at, because you're saying, oh well, Chris, it was going up here, now it's going down here, I can't really tell overall if it's trending or going sideways. This lesson is for you. Okay. After we get through this, I want everyone to have a much clearer understanding of exactly how to distinguish a trending chart from a non-trending chart. Right? Now, just right off of the bat, before we get too complicated, I will add some indicators on screen as we go along. But the first method, in my opinion, that has been around since the beginning of price action trading in order to identify if you're confused with what the portion of the market that you're looking at, which way it's actually trending, here is your meat and potatoes. Higher highs, higher lows. Lower highs, lower lows. I need you to repeat that with me. So if we're trying to identify a downward trending market, otherwise known as a bearish market, we're simply going to look for lower highs, consecutively lower highs, and consecutively lower lows. Right off the bat, on the chart that we're currently looking at, we can already see an example of this. So what do I mean when I say lower highs and lower lows when we're looking to identify a bearish market? I'm talking about the swing highs and the swing lows as the market is ebbing and flowing, as it's working its way in the direction that it's going. Are the peaks consecutively lower than the previous peaks? And are the lows, the troughs of all of these bottom outs, are they consecutively lower than the previous peaks? If they are, if the lows are lower, if the highs are also consecutively lower, then inherently the market must be working its way downwards. So immediately, if we look at this market right here, all right, so we'll start right here on this mark right here. We'll call this a high. We'll mark it off with an H. Excuse my sloppy handwriting. So if we have a high here, okay, and then we have another high here, what do we have? The net change from the high, number 1, and the second high, number 2, is going to be a progress of downward movement. We're working our way downward. So this is a lower high than the previous. So let's see where the next high is. The next time the market actually had some bullish presence, where it kind of topped out at. Well, it'd be right here. So here we are with another high, and once again, this high is lower than the previous high. So we have one high, we have another high, and we have a third high that we've already marked off. And consecutively, kind of like a staircase, you can see that these highs are progressively getting lower. Lower meaning they're going downward. We're not going upward, we're going downward. So the next thing that we're going to look out for, to give a little bit more confirmation to this, is make sure that our lows are also consecutively getting lower. Now, how do we identify those lows? Just like the highs, we're going to go down here and we're going to say, okay, here's low number 1. This is a point when the market found a little bit of bullish presence and it started bouncing its way back up. All right, so we have a low number 1 here. All right, so we're going to mark off another low. The next time that the bears kind of got scared away and went ahead and gained a little bit of bullish strength, that's the lowest point it was able to achieve before bouncing back upwards. So here's another low. So what do we see here? Okay, so 1 and 2. So we've got a situation in which our lows, we have 2 marked off at the moment, low number 1, low number 2. This low is lower than the previous low. So we have consecutively decreasing highs as well as consecutively decreasing lows. And if we keep this going, if we were to consider this a low, it's kind of a weird location too, it is still a decrease. So once again, lows getting lower. And if we're to continue this journey, Here's another spike downward. Once again, new low point, lows getting lower. And this pattern continues all the way down. All right, here's another high. Here's another high. So as you can see, with the little portion of the market that I've marked off, and like I said, please excuse my sloppy handwriting. I'm doing my best there. We have highs that are stair-stepping their way downward. Every high currently marked off has perfectly, now this won't always be the case, but in this example, this is quite wonderful. Every high is lower than the high that occurred right before it. We don't need every single high to be lower than the high right before it. And I'll look for some examples as we go on. If I see some, I'll try to knock them out to you. Where we have an example of, hopefully I can find some anyway, where the highs you might have one high that is now higher than the previous high, but the general direction and the general movement of all the highs is a pattern of actually getting lower, and similar situation with the lows. This is a picture perfect example. It's not always, obviously, as we know with trading, going to go exactly according to plan. So remember, we don't want to lock ourselves in. Just like when we're talking about an area of support or resistance, a lot of times we want to treat it as an area, not so much an exact predetermined to the farthest off decimal place level where we can only trade or expect support or resistance exactly at that number to the tick. We always want to consider the bigger picture. We always want to pay attention to what's actually happening and not get so zoomed in, so to speak, on doing that we miss, what's actually happening. If we were to just generalize what's happening in the market right now, we very easily could see that the market's moving downwards during the period that we have gone ahead and identified a little bit. But if we were to continue this pattern outwards, we'll notice how this looks, what a bearish trend looks like when it ends, so to speak, or when it begins switching from a bearish to a bullish. So we've noticed thus far that every single high has been lower than the high before it, and we notice that every single low in the portion that we're measuring, if we were to pretend that we entered into the market right here, or began looking at the market right here, and this is all the information we have, we notice that every single low is progressively getting lower than the one before it, just like the highs. So we have a very strong example of a bearish trending market. Not a sideways trending market, but a bearish trending market. It has a clear directional heading, and that directional heading is downward. Market is heading downwards. Now, what happens over here, though? So as we move over here, once again, we do see these highs step down one more time and get lower. All right. So we have highs getting a little bit lower. All right. But what's going on with the lows? Looks like the lows are kind of plateauing off for a moment. So it looks like our lows are kind of getting stuck. So at this point, we're starting to notice a little bit of something interesting going on with the market. As we look over here on our most recent high, we're in a situation where our lows no longer are setting lower lows, but more or less maintaining lows. It's at this point that we're going to start to pay attention, because it's possible the market's getting ready to reverse. It's not a dead set thing. We're not looking to jump into a long just yet, but it's going to start perking our ears up. We're going to start paying attention a little bit more, because our bearish trend seems to be potentially slowing down. But while those highs are still getting lower, okay, while those highs are still getting lower, still exhibiting more bearish pressure here than bullish. That's undisputed. If we have bearish pressure plus neutral pressure, the overall pressure is still going to be biased towards the bears. So as we followed a little bit farther to the right, we do have one more big dropout, and once again, the lows do get lower. So here's a situation in which, even though this low was previously was the same low essentially as the low right before it, the market was still continuing on in its bearish manner. It wasn't done and over with. And once again, here's another high, and we did once again continue working our way downwards. All right, but this is where it starts to get interesting, and this is where that low being the same level as the low before it kind of gave us a little bit of foreshadowing. So the low that was when we marked off over here, where the low is the previous, and I said, hey, we might want to start paying attention a little bit. Doesn't mean we got to run away just yet, but we might want to start paying attention. This is when things start to change. All of a sudden, the market's next low, which occurred right after the high, obviously, the net change, here we go, is upward. So now the low, we actually have a low for the first time in quite a while. It is higher than the previous low. The change between these two, obviously, is working its way upwards. So we've got a situation here in which the market now has an increasing low instead of a decreasing low. Now that's red flag number 2 for us. If we're in some type of short here, or we're in some type of situation where we want to take advantage of the bearish pressure that the market was exhibiting, when we start seeing stuff like this, we had our foreshadowing over here. This is our first alert. Call this our second alert, if we will. This is the second thing that's happened that we really don't want to see too much of if we're expecting this market to continue working its way downwards. So let's keep paying attention here and say, okay, what's the next trigger that might cause us to run away? Well, here's another swing high. We had a nice little spike here during this period of the market, okay, giving us another high. And what do you know? What's the difference here? This high is also higher. So if we connect those two highs and we connect those two lows, what do we see? Right here, at this point in the market, we've seen a transition where the lows are now increasing instead of decreasing consecutively. Once again, we wanted those lows consecutively. As we go forward, each one should be lower than the one before it, or most of them at the very least. And the high should be doing the same thing. Now, all of a sudden, we went from a period where the lows stopped getting lower. We had one final low push, and now the lows are getting higher than each other, and the highs are also getting higher than each other. When we see the highs consecutively increasing, and we see the lows consecutively increasing, we have now identified a market that is trending upward. This is what we would consider a bullish trending market. And if we were to continue this pattern and just keep following it outwards, you'd notice that once again, we have another high here, which is a little bit higher. We have another high here, which is a little bit higher. And the market does continue to keep working its way upwards and upwards and upwards. And same thing with the lows. The lows keep getting higher all the way through until we finally have a dip over here. But another example of the market transitioning from bearish to bullish and how we could properly identify it. So we've identified a very clear bearish trend. This is an example of when the market is working its way downward. We see those highs getting lower, and we see those lows getting lower, which means the sellers are mostly in control, and we're witnessing the market mostly travel downwards. So in situations like that, the reason why that information is very useful to us, even though it seems so simplistic, is because if we're aware, if just with such simple price action, if we can identify that the market is heavily traveling downwards, there's a good chance that we can protect ourselves or make some more intelligent investment decisions by simply trying to follow the overall trend. Just like the current in the ocean. If the waves are pushing one direction, or the current's traveling one direction, if the current's traveling heavily north, we'll say, if we see water going heavily north, the waves are moving north, everything's pushing heavily north, generally speaking, we're going to have a lot easier time swimming north, going with the trend, going with the current, than we are going against it. We're a little bit more protected. We have that overall trend on our side. Now, it doesn't mean we want to simply just blind trade and all of a sudden, once we identify that the trend is going downward, we don't necessarily want to just immediately sell and just hope for the best. That would be a little bit too simplistic, but it is a very, very nice backup security blanket to be aware, and that's where the saying, the trend is your friend, actually comes from. When in doubt, we're looking to make a trade. When all else fails, if our position is going in the direction of the trend, we're already doing one thing right. And that's a very good thing for us as traders. It gives us a little bit of a confidence booster, and it keeps one more security blanket on our side, and you can never really have too much of that. You're never going to have too many things in your favor when you're trading. There's no such thing. Next, guys, we're going to go ahead and move over. By the way, let me just take a quick little aside here. Hopefully everybody's having a good time enjoying themselves at the moment and learning a thing or two. I am experiencing, in my part of the world, I live in Florida, we're experiencing some pretty rough weather. If you do lose me at any point in time, I just want to go ahead and get that out there. And I will be trying to get back in here as soon as possible if the power goes down. I do have battery backups, but I feel that I need to let you guys know just in case. We've got some crazy weather going on. I actually just got a notification just now that we have a flood advisory in my area. So if if those water levels get a little bit too high, I'll do my best to try to carry on the webinar floating down the street. So we will keep going here. But nonetheless, so we've identified and we've talked about how to identify a downward trending market. and briefly discussed how to identify an upward trending market. But let's see if we can change that up a little bit and see if we can get a better example of an upward trending market. And it kind of looks like we're going to be running into one right here. So from this point here to this point here, we're going to identify what the market was doing during this time. So this nice little beautiful box that I'm drawing off, very crooked box. So once again, if we know that a downward trending market, a bearish market, so to speak, a market where the sellers are mostly in control, can be identified by lower highs and by lower lows. Once again, bearish market, downward trending market is identified by lower highs consecutively, and lower lows consecutively. In order to properly identify a bullish market or an upward trending market, we're just simply going to look for the exact opposite. So we're going to look for increasing lows and increasing highs. So higher highs and higher lows. Very, very simple. Very, very simple. Yet many traders don't actually even implement this, which is quite silly to me. So we're going to mark off our first low because that's the first thing that we see here in this box. Here's low number 1. All right. And we're going to mark off our second low. Then we're going to mark off our third low. Then we're going to mark off our fourth low. And what do we immediately notice here with all these lows? Right. We notice that all of these lows are consecutively getting higher than each other. That's a good sign. Now, we haven't looked so much at the highs yet, but we are noticing a trend here where the lows are progressively working their way upwards, and that is a bullish sign in and of itself. Now let's go ahead and see if we also have the highs consecutively getting higher. So we're going to start off here. Well, actually on the left, we could count that as a high if we wanted to, but we'll get a little bit better here. So here's high number 1. Okay. Here's high number 2. Here's high number 3 right after it if we want to get real picky. It's not supposed to be an upside down A, by the way. Once again, I'm not great with drawing with the mouse, so I do apologize. Just bear with me. We have another one over here where it kind of looks like it basically stayed right about the same. And then we have a third over here where it continued to get higher. But what do we notice here? If we just quickly glance at this and someone said, okay, you have to decide, are the highs mostly increasing, mostly going sideways, or mostly decreasing? What are you going to say? Well, hopefully, you're going to say that they're mostly increasing, which is a bullish sign. Hopefully, you're going to say that the general pattern here, what we're mostly noticing, is upwards. So once again, we've seen our lows increase. This low, okay, this low right here, number 2, is higher than the first one. And the third one is higher than the second one. And the fourth one is higher than the third one. So the pattern here, obviously, like we already discussed, is upwards. The lows are getting higher, which is a telltale sign of the market working its way upwards. So we wanted to confirm that. We wanted to check the highs as well. And what do you know? The highs, generally speaking, are all higher than the one before it. The only one that's really in question here would be the high that we have over here, which would have been essentially our fourth high that I have marked off. I have 5 total marked. The fourth one is right about the same level as the other one. So it's at this situation here that we might be a little bit more cautious. We might say, hey, this is our foreshadowing that maybe this bullish trend is getting ready to come to an end. And generally speaking, after we start noticing those things, it isn't too many highs over to the right or lows over to the right that all of a sudden we notice that transition, just like the other example we were talking about. So this is just very simple price action, but you're already starting to see how well it can give us some insight into what the market's actually doing. Once again, people will get the notion that you have to use 600 indicators or you have to have some private coded indicator in order to give you the holy grail, in order to pull the trades out. But people spend their entire lives looking you're just about looking for these magic indicators and these magic trading systems, when realistically it's just laziness, because a lot of the information that we need in order to make profitable decisions is in front of us without an indicator to begin with. A lot of times the indicator is just trying to bring to light the information that is already in front of us. As a matter of fact, that is literally all they are doing. An indicator is just providing us another way to interpret the information that is currently being displayed in front of us visually. But really, if that information is just simply in front of us, why would we not just utilize it? So just paying attention to simple things like this and not turning our nose down or up or left or right to very, very beneficial things like how to properly identify which way the market is trading can lead to very great gains. It can lead to excellent gains. It can lead to an increase in our return on investment, our ROI, if you will. It can lead to a number of beneficial effects on our trading lifestyle and our trading results. Because if we're constantly trading in the direction of the trend, we're going to be giving ourselves a situation where we have a hell of a lot more that can go right for us than a hell of a lot less, and we have a hell of a lot less that can go wrong against us. Like I said, it sounds so simple, but guys, trading with the trend really is our friend. And being able to properly identify it, yes, it is a skill set, and you might want to practice it in and of yourself, but it isn't that difficult, and it is so darn rewarding. So moving on, we have a situation here where once again we talked about how to properly identify a bearish trend. Then we talked about how to properly identify a bullish trend. We showed some examples of the lows for the bullish trend, which is the upward moving market, the lows getting higher consecutively, and the highs getting higher consecutively. Okay, so let's go ahead and see next if we can find an example of when the market is moving mostly sideways, all right, and what that might look like. All right, and it looks like just right on over here, we're kind of given a perfect example yet again. I'm going to scroll though. I'm going to see if I can find a better one though. We'll go back to that one if we want, but I have something in mind that I'm looking for. Okay, this will probably do a little bit better. All right, so taking a look at this portion of the market from, 1 second, we'll zoom her in. All right, we're going to look at the market from here to here. So basically the center of my screen, I'm just going to box it off with my terrible boxing skills, and then we're going to talk about what the hell I'm talking about here. So in this portion of the market, we talked about already, just a quick recap, keep us all on the same page. We talked about what a bullish market looks like. That's when the market is trending upwards, how we had those highs increasing, how we had those highs getting higher, and then we had those lows also getting higher along the way. And then when we reversed that, we had a clear way to identify a bearish or downward trending market, and that was with the highs getting lower consecutively and the lows getting lower consecutively. So we talked about both those situations. Now we're looking to talk about what happens when the market isn't doing either one of those things, when it's going sideways. A lot of times traders choose to avoid trading during a sideways trending market, which is what this is referred to, or otherwise known as a range-bound market. This is essentially when the supply and demand is virtually neutral, or we have a period of lower volume. It's a period where the buying and the selling is essentially equal. So as such, you're not seeing the market really rise any, and you're not really seeing the market fall any, right? So taking a look at the market as it sits, once again, let's just focus in on the area, that box. I'm just scribbling the side away because I thought it'd be a good idea, immediately realizing that because my poor drawing skills probably might be confusing some people, but let's focus in on this beautiful, beautiful square rectangle shape that we've got going on here. So we have a situation where here's low number 1. Mark that off. All right. Here's high number 1. Here's low number 2, 3, and 4. 1. Well, that's technically 2, but there's 3, and there's 4. And we have a high here, and here, and here. So, at all of these points, what are we noticing? Are we noticing the highs getting higher? No, not so much. Technically, the highs are getting lower. Not really, but they are. If we want to get it, to the tick, they are technically getting lower, but very, very marginally. And what are we noticing with the lows? Well, the lows are mostly exactly the same. The lows are almost identical. The last 3 lows that I marked off are all at the same price. We have the lows almost sitting at the exact same location. Technically, our first low was a little bit lower, so maybe we had a little bit of bullish sign there. If we want to get real, like I said, real technical with it. I don't want to say that word again, but I don't know how else that I should get this through. So we've got the lows with a slight but mostly sideways situation going on. A slight bullish but mostly sideways situation. 3 of the lows are exactly at the same location as each other, with only one, with the difference between the first low to the second low was the only bullish presence that we saw. Now the highs, once again, technically they're slightly getting lower, but very, very close to each other, mostly sideways. If we had to decide, is this more of a circle or is this more of a square? Well, just by looking at the box, if we were to just use my ugly box as an example, if I were to say, can you tell me, is this more of a circle or more of a square? Hopefully, you're going to say it's more of a square. Now, to the exact definition, maybe it's more of a rectangle, but that's not the question. Okay, we just want to keep it simple. Is it more of a circle or is it more of a square? Is this market, now, and this is where this ties in, folks, is this market more of a market that's moving up or down, or is it more a market that's moving more sideways? And the answer should hopefully be it's mostly moving sideways. We're not seeing a whole lot of progression here on either the high side or the low side. We're mostly, if anything, just kind of squeezing in. We're getting a squeeze on the market. We're moving a little bit tighter. The range is getting a little bit tighter. That pressure is just kind of working its way into a very tight range where we're trading between what became all of these lows are at an area where obviously we're finding some type of support. And up here, it looks like we're finding some type of resistance, although the resistance is a little bit less defined with the way that these highs are marked off. But this is an example of a market that we would consider a sideways trending market, a range-bound market. The reason why we consider it a range-bound market is because we have 2 centralized locations that the market is essentially ping-ponging between. We have an area near the highs where the highs are all right around the same location, and the market is constantly finding resistance around that high location. And the lows, every time the market works its way down to a previous low, it starts finding support and working its way back up, therefore making another low around the same location. In essence, we're seeing a market that is mostly going to the right, obviously the market's always going to the right, but we're seeing a market that's mostly traveling in a neutral manner versus gaining bullish presence or gaining bearish presence. So we're not seeing the market really climb, and we're not seeing the market really decline. We're more or less seeing the market exist, if that makes sense. Now, when we're trading, obviously there are different types of trading. In some trading, we don't want the market to move. In some trading, we do want the market to move. But when I generalize it, most traders are making money based on how far the market moves in the direction that they're expecting it to go. Because of that one fact, that one little bit of information right there, if the majority of traders are making money based on how far the market goes in the direction that they're forecasting, most traders would prefer to stay away from a market that is trending sideways. Why? Because it doesn't matter if you bought or you sold here. Even if somehow you did find a way to come out of that buy or that sell profitable, if you're making more money when you buy, the farther the market goes up, and you're trading in a sideways moving market, it doesn't really stand to go up that far. And if you're making more money when you short the market, you want the market to crash, and it's going sideways, it doesn't really stand to go down that far. Therefore, you're not really looking. Your risk isn't very high, obviously, in a range-bound market, just due to the fact that there isn't a whole lot of activity going on itself. But your reward isn't that high either, and we might be wasting our time trading where commissions or spread or whatever it is could be making it actually an unprofitable situation for us because we just don't stand to move far enough in the direction to overcome that spread or to overcome the commissions that we're paying when we're trading. So this is an example of a sideways moving market. Now, trading sideways moving markets is possible, and some people do prefer it. But I'm just speaking as a mass generalization. The majority of traders are making more or less money based on how far or not far the market is moving are not looking to voluntarily jump into the market during a sideways moving trend, and it's a mistake. Or it's an anticipation of a breakout that's occurred during some type of tightening wedge formation, or just some type of tightening in the market in general that they're expecting it to explode out of that range, and they feel for whatever reason they know which way it's going to go. But once again, by identifying the highs, the pattern that the highs are doing, and the pattern that the lows are doing, it's pretty apparent here that we're not dealing with a bullish market. The overall direction here isn't upwards during this period of the market that we've got marked off, and the overall direction here sure isn't downwards either. So we're dealing with a sideways trending market, or a range-bound market. This is a very tight range-bound market, as a matter of fact. We didn't really move very far between these two numbers. There wasn't a whole lot of movement in general. But this is a market where if we're looking to just flat out buy or flat out sell, we might want to avoid it. Now, we're going to take it one step further. Try to keep with me with this one. It is still possible, and there are traders out there that prefer this type of market. Now, why would a trader prefer a market that really isn't going anywhere? A trader that's trading some type of position that think of an option. Okay, if you're aware of what an option is, think of an option. Think of a touch. Think of a no touch. Think of an option where you're making a statement. All right, and there's a few different ways that this can be done, obviously. But think of a trade where you're making a statement that you're saying the market will not be above, say, 1.195 at a certain amount of time. So you notice the market, and that's this here. Let me clean this up. 1 second, folks. So we're going to focus in on this portion of the market to this portion of the market. Just drawing my quick little box again. Okay, and we've identified that the market is mostly moving between a very tight range. Okay. We've identified that we seem to be finding resistance near the 1.1935, which is this top level here. And we identified that we're mostly finding mostly finding support near the 1.191, which is this bottom area of support here. So we've got ourselves, we've already identified by using our high and low trick, by marking off those highs and the lows and realizing that they're not really making any progression upwards or downwards. We've already identified that the market seems to be stuck. It's not really getting anywhere. And say we have, our broker gives us an option where we are looking to make a statement, just in the trading community in general, where we're using a position, we're making a trade where we're saying let's see what time this is. We're saying by 2 o'clock, all right, which right about here, by 2 o'clock, okay, we're going to say by 2 o'clock, which is this big line here, the market will not be above 1.195, which is here. Okay. So we're making a statement that at 2 o'clock, this big long arrow here. I didn't mean to draw that one. Draw an ellipse, but we're saying at 2 o'clock, the market will not be above that location. Okay. This is where properly identifying a trend, a sideways moving, a range-bound market can be profitable to us, because if we're aware that the market seems to be pegged in between these two locations, we're not seeing a whole lot of volume, we're seeing the buying and selling pressure virtually neutral, we're not seeing the market go somewhere, taking a position where we're making an investment that says we're not expecting the market to be above a location that is rather far away from where it's currently located relative to how much activity the market is exhibiting, might not be a bad idea. And that is what you'll notice some traders do as well. This is just, once again, I'm not saying you have to do this. This is just another way that traders will trade, utilizing options to more or less take advantage of a sideways moving market. There's a way to trade every type of market out there, whether it's moving sideways, whether it's moving upwards, whether it's moving downwards. This is just a little bit more of a complicated way to explain it, but it is, once again, it is definitely doable. We can make profit on the market when the market is trending upwards, like we talked about, by buying, obviously, if we're aware that the market is moving upwards. we might want to just try to identify any one of those low swings to look in for our buy and ride that market up until we start noticing those highs no longer consecutively getting higher, and we notice that those lows are no longer consecutively getting higher. Then we might want to consider closing out our profit, closing out our position. And we talked about with a bearish market, when the market is in a situation where those highs are actually consecutively getting lower and those lows are consecutively getting lower, we might be looking to get in to short the market during any one of those upswings, during any one of those quote-unquote high periods, and look to short the market in anticipation of that overall bearish momentum that the market is being controlled by. And we might want to ride that position. We might want to ride that position downward until we notice for some reason that those lows are no longer consecutively getting lower. Maybe they just kind of bottomed out. Maybe the lows are constantly sitting around the same location, or maybe even worse, those lows are now all of a sudden starting to get higher. And if we're selling, we don't want to see lows increasing. We want to see lows decreasing. Same thing with the highs. If we're selling, we want to see those highs consecutively getting lower. And if we start noticing that those highs all of a sudden are starting to stay the same, or we're starting to notice those highs get higher, we might want to consider closing out our position, taking the profit we have, because that's a sign that the trend relative to what we were trading might be reversing. That bearish trend that we were involved with all of a sudden might very well be switching over to a bullish trend. And if we're selling the market and we're making money the farther it goes down, we really don't want to be involved in the market in that type of a position if all of a sudden it looks like the market's about to be going upwards. So bringing us full circle, coming back down to talking about a sideways moving market, profit can be achieved utilizing things such as options in order to make a statement saying when we identify that the market is stuck between 2 points, two strong areas, meaning a strong area of support, a strong area of resistance. The market seems very tightly range bound between these 2 points, like we were just discussing here, between the 1.191 and our 1.1935. The market seems stuck between these 2 points. It could be very advantageous for a trader to make a position that's essentially a statement saying to open a position anyway. It's a statement saying we do not expect the market to be above a price that is outside of that tight range that's above the resistance, or it could go the other way around. We could say, we don't expect the market to be down here, okay, by 2 o'clock. We don't expect the market to be, down here by 2 o'clock. Say we expect the market, we're making a position saying we don't expect the market to, or opening a position, be at or below the 1.1895. And the reason that we pick that number is because it is a price that is outside of our tight range. And not only is it outside of our tight range, it's almost the distance. The distance from the bottom of our range to this price location is almost the width of the entire range in and of itself. So it might be a very reasonable decision at that point in time in the market. Now, I'm not saying anyone has to actually implement these strategies. I'm just trying to give you all the information so you have a better idea of how to handle these different types of markets and how you might be able to profitably trade them should you get involved. So, at this point in time, does anybody have any questions? I've tried to keep this as straightforward as possible. I know that sometimes, just with the way that I speak, and sometimes my drawing skills are a little bit sloppy, and I do apologize for that. I can make things a little bit more complicated than they need to be, but I hope I've really cleared up what a bullish market looks like, how to properly identify with no extra help. You don't need any extra help. You don't need any indicators. I just showed everybody how to properly identify a bullish trending market without any help on naked charts, as well as how to identify a bearish trending market or a downward trending market, once again, on naked charts. Remember, upward market, higher highs, higher lows. Bearish market, downward market. Lower highs, lower lows. Sideways moving market or range-bound market. Similar highs, similar lows, lack of general progression, either up or down. Once again, mostly moving sideways. We talked about how we might want to get in in anticipation. We talked about how we might want to buy during a bullish market because the overall pressure is pushing us upwards, and it generally seems to be quite a lot safer, right? We talked about how we might only want to sell during a bearish market because the general pressure is downward, and we talked about how utilizing the proper identification of a market that is stuck or locked between 2 points in a range-bound market, we can utilize that information to also profit by making statements that say we're not going to be touching this location or we're not going to be above this location at such and such a time. So there is profit to be made in any market type. Obviously, you might decide that this type of trading isn't for you, or maybe that type of trading is, but that one isn't. It's all a feeling out process. But there is ways to do it in every single way. The more we know, the more tools we have, the more adept we are at dealing with situations on the fly and dealing with them correctly. That's why simple things like this, it's extremely important not to turn our nose to it, to really, give everything a valid chance and to just simply not feel like we're too good for it, because sometimes it is the most simplistic traders that will end up walking away, pulling the most profit on a day where they didn't use any indicators. And then you have a trader that says they've been trading for, 5 to 10 years, utilizing all these different indicators, and they're getting walked all over by a trader that's only been trading 2 to 3 years, but using base price action skills because they're not confusing themselves and they're using things that have been around since the beginning of trading, things that have been proven to work. But other than that, folks, it has been a pleasure. I do appreciate everyone joining me again for another beautiful webinar here on Monday at Earn to Trade. I always love doing these. I have a great time with them, a great time with you guys, and I feel like I might be actually getting ready to lose some power here, so I am trying to wrap it up. The storm just started kicking up. I don't know if you guys can hear it on the microphone, but I have a metal roof and it's getting quite loud. But it has been a pleasure, though, guys. And if you have any questions past this point, they don't have to sit in your brain. You don't have to think that you'll never have an answer to them. You can schedule a mentoring session with us. You can, you can ask us. There's a number of ways that you go about getting the answer to your question, even if you come upon your question after I close off here in just a moment. But it has been a pleasure as always. Thank you guys for joining me again for another wonderful webinar. I hope everybody has a very profitable trading week this week. And if at the very least, remember, profit isn't always measured directly in dollar signs. Profit can be measured in what you're gaining knowledge-wise as well. Knowledge is power, folks, and it is extremely imperative that we understand that the more we know with trading, the better off we are going to be in the long run. Absolutely. But thank you once again, everybody. I hope you all have a wonderful Monday trading and a wonderful week as well. I will see you later on when I do the daily recap. Hopefully you're joining me back then so we can stay ahead of those markets. But thank you once again, guys. Have a wonderful day. This has been another wonderful webinar on trending versus sideways markets and how we can deal with them. See you soon, guys.